Good morning, good afternoon, good evening, wherever you are in the world. I'm repeating because I'm not sure about the previous recording glitch. I'm Nicolas Veron. It's my pleasure and special honor today to introduce this session of the Financial Statement series at the Peterson Institute for International Economics, because we have two very special guests today, starting with Charles Goodhart, who of course is one of the titans of the global economic profession. So it's a bit intimidating for me to welcome Charles and also Viral today to talk about, as you will join me in noting, a very original topic. Charles, I just learned that during his military service in 1956, Charles was involved pretty directly with both the Suez crisis, which he almost joined on the ground, but it was cancelled before he could participate, and in the Hungarian events, because some refugees directly from Budapest to Britain were hosted in barracks where he was also involved. I'll leave it at that. It just gives a sense of the depth of historical experience that Charles brings to any conversation, and particularly any financial conversation. He studied at Cambridge in economics, then at Harvard, where he got his PhD in 1962. Then he went back to Cambridge, worked on the history of British banks, also served at the British Department of Economic Affairs in the mid-60s, and then at the London School for Economics and Political Science, the LSE, from 66 to 68. In 68, Charles joined the Bank of England and spent nearly 2 decades there until 1985. He was a senior advisor at the Bank of England in the first half of the 1980s. And then he went back to the LSE in 1986, where he stayed until 2002, and since then as emeritus professor of banking and finance at the London School of Economics, where he also co-founded there the financial market groups in 86, together with Mervyn King, I think. I'll basically stop there because it's impossible to mention all the achievements and major contributions of Charles Goodhart, so I better not try, but just to say that he brings more perspectives than anybody I can think of to the conversation we'll have today. Viral Acharya studied at the Indian Institute of Technology in Bombay. It was called Bombay at the time. He graduated in 1995 in computer science and engineering. I have to say he won the President of India gold medal at the time, which was an award for extraordinary academic achievement, of course. And then he started a PhD in computer science, but then decided to evolve it into a PhD in finance at New York University, where he graduated in 2001. Viral then taught at the London Business School until 2008, and then since then at the New York University Stern School of Business, NYU Stern. He did take a leave for 2.5 years from early 2017 to mid-2019 as Deputy Governor of the Reserve Bank of India, India's central bank. And he also just started, I think a day or two ago, a sabbatical at the Federal Reserve Bank of New York, closer to home, also working on policy issues. So with that, I will be moving Charles' slides going forward, and let me share my screen for that. Charles, over to you.
Thanks very much, Nicholas. I thought your introduction was rather a long way of saying that I'm now quite old, which I fear is true. Can we move on to the next slide, please? Moral hazard occurs when faced with a risky prospective action. An agent gets the benefit of the upside, but is protected from some or all of the downside costs. And the two largest sources of such moral hazard nowadays are insurance and equity limited liability. Some people tend to think that limited liability does not provide a moral hazard, because if things go wrong, the shareholder loses his complete stake. However, it's only the stake in that asset. All other assets remain, and any responsible or well-advised equity investor, retail equity investor, will be diversified over many such assets. As a result, retail equity shareholders are as much subject to moral hazard as anybody with insurance. Banks are very strongly affected by both these sources, with deposit insurance and limited liability for bank equity holders. But decisions are taken in banks effectively by bank executives. And that moral hazard became much worse when the top bank executives became remunerated largely in the form of stock options, rather than, as had been in the past, fixed salary. That all occurred about 3 decades ago, around 1993, following a measure introduced by President Clinton, which was actually intended to align the incentives of bank executives with those of bank shareholders. Next, please. Next slide, please. Nicholas, there we go. Thank you. Now, historically, in the old days, there had been multiple or unlimited liability. In the 19th century, in my country, the UK, bank shareholders had faced unlimited liability until about 1878, with the City of Glasgow crisis leading to a reconsideration, and the US had double liability until the 1930s. The episode of the 1878 City of Glasgow bank failure, when a very large number of the shareholders who had no possible knowledge of or control over the policies undertaken by the executive of the City of Glasgow Bank. Indeed, that even included their Edinburgh branch managers. And effectively what that meant and means is that shareholding extended then beyond family and close friends, and then the ability of the more distant shareholders to constrain or influence bank executives' behavior reduces really to very low levels, unless the shareholder holds a very large proportion of the shares sufficient to be able to undertake takeover bids, etc. With limited liability, all bank shareholders face and indeed enjoy the same moral hazard and will cheer on the assumption of greater risks because it's in their interest to do so. With such moral hazard, it will be the interest of relatively risk-loving bank executives, particularly those with stock bonuses, to adjust the information available to those who might constrain their actions, such as bondholders and supervisors, so that those constraints do not in practice actually bind. On to the next slide, please. Now, one of the supposed mechanisms for reducing excessive banking risk is to require banks to maintain some minimum proportion of uninsured creditors, notably subordinated bondholders. The problem here is that such debt holders will most often not actually have the requisite inside information, nor the ability by their actions in aggregate to constrain bank executives. I know of really very, very few cases indeed where the effect of bondholders' changes in their interest rates has actually shifted bank behavior. For example, Cicchetti and Schoenholtz, in a recent paper on bank regulation, state that requiring the issuance of long-term subordinated debt seems the least effective of the proposals for strengthening existing standards. On to the next slide, please. What we're then left with is proposals to require banks to maintain ever higher capital and liquidity ratios. The problem with that is twofold. First, it leaves unresolved the incentive on bank executives, and indeed many other shareholders, to find ways around the multiplying and restrictive regulatory controls in order to enjoy the benefits of moral hazard. Second, it will be argued that the additional equity capital liquidity is actually unnecessary, can be described as idle in many historical cases, and will increase the cost of banking, driving financial intermediation into less regulated non-bank financial intermediaries. Next slide, please. Greg Baer, if I pronounced it correctly, the president and CEO of the American Bank Policy Institute, wrote effectively in the lines that I suggested, saying that this will shrink the availability of credit, raise its cost, won't be necessary, and will drive financial intermediation out of the banking system into the non-bank sector, and may actually make the US financial system less stable and resilient to economic shocks. It's if you like, a fairly standard argument. On to the next slide, please. Now, I think it's quite difficult to refute these claims, for example, on the grounds that extra safety would reduce funding costs in line, sort of Modigliani-Miller. Some have argued in those lines, my friend Anat Mati, for example. But I think that it is difficult to argue that it's actually strictly necessary if the incentives to the bank executives were improved and correct. And moreover, banks can and do have the ability and the financial heft to get the ear of politicians. So there tends to be a regulatory cycle with the restrictive requirements getting loosened in good stable periods and then raised again after each banking crisis. With the incentive for the regulated still to take on more risk than the regulators would like, neither side is now happy at all. The regulated, among the banks, the bankers, feel that they're hedged about by an ever-expanding thicket of unnecessarily restrictive regulations and supervisory oversight at some very considerable cost to themselves and to the economy. In turn, the regulators and supervisors feel that the banks are always seeking to exploit any loopholes they can find and use their political muscle to water down regulation and prioritize profit over safety. In a sense, we are in a situation where neither side, the regulated nor the regulators, are happy. Next slide, please. So the argument that we make is that there's another way forward. And that is to try to realign the incentive structure for senior bank executives who take the key decisions so that they no longer face moral hazard. That would imply, in our view, returning some way for a class of senior informed bank executives and controlling shareholders towards the old system of multiple, or even for the CEO, unlimited liability. The extent of multiple liability should be related to their access to inside information and their ability to influence or control decisions. But the ordinary retail investor has no access to inside information and no ability to influence executive decisions. They would, of course, remain with limited liability. In the article, co-authored with Rosa Lastra, we give a sketch how multiple liability might be applied in section 3 of our paper on equity finance matching liability to power. Next slide, please. The guts of the proposal are set out on page 13. Effectively, it's to try and make insiders, and I admit that the definition of who is an insider and who is not, it's not easy. But you can do this in terms of relative pay, and you can do this in terms of their position on boards, senior directors, et cetera, et cetera. And again, the question of whether outside shareholders of a controlling position is also tricky. I'm not saying that this is easy, but it could be done. Next slide, please. I think also that there should be a process of potential appeal against any additional loss incurred, perhaps to a special court with a mixture of people on that court. For example, say you were a Japanese bank and there was another major earthquake in Tokyo and things go wrong, it's clearly not your fault. But what we would suggest is introducing such a reform on a kind of gradual basis. We're quite struck by Peter Conti-Brand's proposal in 2012, making systemically important financial intermediaries subject either to much higher capital requirements, or, he argues, to making all shareholders subject to unlimited liability. Now, we think that the weakness of his proposal is the unfairness and enormous political unpopularity of bankrupting uninformed, innocent, and powerless outside shareholders if things go wrong. So what we would suggest instead is to give such SIFIs the alternatives of either much higher capital requirements or adopting a two-tier equity system along the lines that we have outlined gently here and at much greater length in our paper. Only the SIFI's CEO might then have unlimited liability, but other insiders could have multiple liability. If the experiment was successful, it could be extended to other financial institutions and insurance undertakings, etc., etc. Next slide, please. One criticism that we would refute is that it would sharply constrain the number and quality of those wanting to become senior bankers. There is no evidence that he did so in the 19th century at all. One intriguing question is whether it might make bankers too risk averse. One of the issues that I think is important and not studied enough, and I hope that upcoming brilliant economists like Virral will take on, is what is the optimal degree of bank risk-taking in our economies? How could you assess and quantify that? And how can you change the incentive structure to get bank executives to take the optimal degree of bank risk-taking without having to have such enormous and rather constraining and costly regulatory books, massive increases in bank capital, liquidity, and so on. But I'd like to end finally with some other proposal to change bank managerial incentives in order to limit risk. It was set out in our section 2 in our paper on pages 8 to 12. Next slide, please. Peter Conti-Brand's 2012 paper already mentioned. Changes to governance structure, changing the statutory duties of boards, Mayer, Schwartz, Kakinis, and so on, but he wouldn't change the pecuniary incentives of bank management, which is where I think the key issue lies. Tom Huertas wants to pay managers partly in bail-inable bonds. My discussant, Virral here and others, want to pay managers partly in deferrable cash form. Patrick Bolton wants to relate compensation to CDS spreads. Calamiris and Dick Herring want to issue many, many more COCOs. And they're all good, but I don't think they go as far to any extent as the much more comprehensive adjustment and reform that we want to introduce. There's also been a senior management and certification regime in the UK in 2013, but I've really had no evidence that this has had any particular effect on bank managerial approach to risk. As I'd like to end up, perhaps a version of the Conti-Brand scheme adjusted to include our proposals might be tried. What I'd like to end up with is a plea, particularly aimed at Virral, to say, could you somehow work on the subject of what is the optimum degree of risk? How can we assess it? And how can we get the incentive structure so that bank managers are naturally induced to follow that approach?
Thank you so much, Charles. That was, of course, masterful. And I should have mentioned at the outset that the paper which Charles referred to as this one, Equity Finance Matching Liability to Power, which was co-authored with Rosa Lastra, who, like Peter Country Brown, was a guest of this series a couple of weeks ago. And that was published in the Journal of Financial Regulation in 2020. Viral, over to you.
Thank you so much, Nicolas, for inviting me, and thank you, Charles, for such an illuminating presentation as always. I think let me start out by just clarifying a few basic points which I think are important to keep in mind. There's a tendency to dismiss moral hazard concerns as contributing to banking problems. The way someone told me once was, oh, I never walked into a bank thinking that I'm getting a bank bailout. And of course, that's right. But I think they fail to understand that their incentives are shaped by their costs of capital for bankers. And so for the large part, the cost of bank capital remains invariant to their risk-taking. This can actually be seen in data. There are studies which show that creditors do not price risks of too big to fail or too systemic to fail institutions the way they price other institutions, or especially the way financial institution risk is priced compared to non-financial institutions risks. And so I think this point is important, which is that the moral hazard actually works through the price mechanism, which is that bankers undertake risks, they are loading up on risky strategies, but they find that their cost of capital is invariant. And so until the risks are paying off on the good side, their return on equity looks spectacular. And they start attributing the beta of their strategy, which is that they're taking on substantial risks or aggregate risks, to their alpha, which is their own skill and expertise. And I think this is important because it's a very simple point, but I think which is misunderstood. And I think there's almost a belief in macroeconomic discussions of banking that if you talk about moral hazard, you are a particular type of economist who doesn't see the big picture about how the world works. And I've seen no more dangerous discussion actually taking a lot of, getting a lot of support, because I think if we ignore incentives, I don't know what economics is about at the end of the day. I thought it's all about actually, people maximizing their objective functions and things not always coinciding between social and private good. But just one last point on this prelude before I get into Charles's specific recommendations is that even Lehman Brothers, the most spectacular bank failure of our times, is misunderstood in my view. Everyone refers to Lehman Brothers primarily as evidence of contagion. And I think it's true. Lehman Brothers is evidence of a lot of contagion in the financial sector. But if you read Hank Paulson, who was the US Treasury Secretary's journal, I believe it was called On the Brink when it came out as a book, it says very clearly that in April and May of 2008, before Bear Stearns collapse, Lehman Brothers had an option to sell itself to a Korean knight, and they refused. And Timothy Geithner and Hank Paulson got on the phone to the CEO of Lehman Brothers, Dick Fuld, and asked him, why aren't you taking up this offer? And he said, you got Bear Stearns shareholders $10 per share through a deal. Why won't you get it for me? And I thought this was classic evidence of moral hazard at work, where a deal in which shareholders actually walked out with something, Bear Stearns survived in some form, but inside, of course, the balance sheet of JP Morgan altered the management behavior to actually exit out of Lehman Brothers at the right time. And in a way, the world paid for it, of course, in fall of 2008. So I just wanted to put this on table, which is that because there are so many folks who believe that moral hazard is not even a consideration, I just wanted to put that on the table. Now, there are two reasons why I think Charles's proposal needs to be taken very seriously, in my view. The first is that we have gone through now 15 years of trying to strengthen capital requirements, coming up with various kinds of contingent capital instruments like COCOs, etc. And earlier this year in March, we have just seen that in spite of that, we managed to not control very basic risk seeking through positions in treasuries of the US government. Okay, banks took on interest rate risk in the United States and we failed. On the other side of the pond, we had a bank, Credit Suisse, which was basically running aground for 2 years in terms of losing 75% of its market cap, losing it month after month after month. We had all kinds of capital planning, etc. And yet the bank failed spectacularly. And then none of these measures, such as resolution planning, etc., were ultimately employed. I think this should give us a pause that the approaches we have adopted clearly work better for some banks, but they are not foolproof. They are not robust enough to actually guard us against these failures. And once again, we ended up extending the central bank's lender of last resort to many institutions. The second reason, which I think is also equally important, is that if we have to think that increasing capital, etc., will improve the shareholder governance of management, we have to ask how. Okay, which is, are the shareholders, when they see signs of problems by management, going to respond by exiting their shares? Are they going to respond through voice? Are they going to be active in the boards? And my sense is that this sort of discipline becomes very weak when the individual holding of shares by an informed shareholders is not very large. If you look at the large banks of today, the toehold of any one investor is so small that they can neither vote by exit nor by voice. They cannot credibly change management behavior through either of these mechanisms, which is the typical mechanism. Just think about taking a large stake in JP Morgan. Okay, what would it take to be active as a shareholder on JP Morgan? Okay, this is a non-trivial financial investment for any shareholder out there. Where am I going to with all this is that this is the reason why I think the other measures need to be complemented with what Charles is pushing, which is that we need to create state contingent penalties for management when things go wrong. Okay, and I think that's another way of interpreting unlimited liability that Charles is proposing for insiders, the board members, and the management. Okay, so now there are various forms that this could take. One way, and I think Charles didn't have time to go through this, but of course there are clawbacks that are being proposed. I think this is a bit difficult in my view, because once the payments have been made, getting them back will invariably be a very contentious legal battle, and invariably lead to some settling up rather than actually being able to recover the claims.
Right.
I have 1 minute, or I have to wrap up? 1 minute, okay. Another possibility is of what is done in trading compensation contracts as a bonus versus a malus idea, which is that rather than rewarding people for good performance on the upside, unlimited liability is like a malus on the downside. But how do you make the malus work? You have to preserve all the gains of the trader into this account. And then if things go bad, then there is malus, which is that this reserve account gets written down, and then the payout won't be as large. It starts looking a little bit like initial and variation margin contracts, which is that you have to ask the management to put up an initial margin to become the CEO of a bank. Then there'll be a variation margin based on your performance. This will go up and down, and you basically can't get your final payout until the contract settles, which is until you leave, and I would say until 3 years after you leave a bank. And I think that would be a way of making this work. And last point here, which is that overall, I think we have to embrace the idea that that anything we are trying to do on capital requirements, contingent capital, has tremendous model risk associated with it. I think we just have to be a bit humble about being able to get the measures of risk right. I think this is exactly the question Charles is posing to me, which is how do you figure out the optimal level of risk for a balance sheet in the financial sector? And I think we can make progress, but there's going to be invariably a lot of model risk associated in answering that question. And therefore, you need a belts and suspenders approach. And I view Charles's suggestion to have unlimited liability for bank management and boards, having some kind of bonus versus malus or a margin style payouts to them, only settling up ex post after their terms are over, as being adopting this robust belts and suspenders approach. One last thought on this, which is something I don't have a good answer to, but it bothers me a lot, so I keep thinking about it, which is suppose we create all these mechanisms for the unlimited liability, how much can the management undo in private markets? Which is, can they go out and write hedging contracts? Can they borrow against their locked up bonus malus account? Should there be some restrictions on this so that the incentive effects of this bonus malus or margin account, etc., are not being undone, or unlimited liability is not being undone in private markets through derivatives, etc. I think one needs to give some thought to what restrictions on and disclosures might be necessary to make the unlimited liability bind. But let me pause there and open it up for Nicholas for questions.
This is fantastic. Thank you, Viral. We have also, for those who are registered on Zoom, an extraordinary wealth of knowledge and experience among the audience. So I encourage them to use the Q&A tool and ask questions, which I will then filter to Charles and Viral. But before we get there, Charles, do you want to respond to some of the Viral's provocations?
No, I agree generally with virtually everything that he said. I would say one thing. He said, and I agree with him, that price is not properly priced in. Risk is not properly priced in. The point that I would make is that I think the incentive in institutional structures as such, it actually can hardly be. And for example, the accountants are working to bank management. And bank management will, with the accountants' help, provide as strong a position as is humanly possible, subject to what is legal. If you look at most crises, what tends to happen is that prices, whether of the local bond or the equity share or whatever, doesn't move all that much until about a day or so or 2 days before the crisis, and then it absolutely collapses. And there's no sort of steady trend as the risk clearly gets worse. The risk is very largely hidden because it's in the interest of bank managers to do so. And that means that actually believing that you can rely on markets and risk pricing to provide constraint on risk taking is, I think, overstated. And indeed, as Viral pointed out absolutely correctly, bail-in has been, if you like, tried twice and not used on either occasion. Is our regulatory system actually fit for purpose, let alone that I think that it is, as I said in my words, I think it causes both the regulators and the regulated a lot of unhappiness. I do think that we do need to think of alternative measures, and I would be only too happy if Viral somehow was in charge of the organization of these alternative measures.
So I'd like to get a bit of your sense of what happened earlier this year, right? We had, let me just focus on two things. At Credit Suisse, in a way, there was some bail-in because the AT1 instruments were famously brought to a value of 0. It was a bit messy because the shareholders got some money, but not that much. So the big picture is one of bail-in, just not as much as probably would have been necessary if they had triggered the formal resolution process. But there was some, and it absorbed some of the losses enough that basically there was no need for use of public money. Guarantees were provided, but they've now been withdrawn and they haven't costed anything to the Swiss taxpayer. So that's one example. So other example, well, then I'll come to Silicon Valley Bank, but why don't we start with Credit Suisse, Charles? What lessons do you draw from that episode? Isn't it in a way a happy story?
One of the lessons I draw is that if the crisis is serious, as it was in the case of Credit Suisse, that the politicians will inevitably be drawn in, and you will get politics and political influences will determine how the resolution is undertaken, quite irrespective of whatever is laid down in the bail-in process. It will be a political process. It was not, I think, a particularly successful political process. The general public in Switzerland, as I understand it, would not want and did not want and do not want Credit Suisse to be folded into UBS. They would have much preferred a resolution process which would have allowed some kind of successor vehicle to Credit Suisse to continue to provide an alternative bank outlet, more competition, and in Switzerland itself. So it was a politicized process, not necessarily what the public wanted at all, and certainly not along the exact lines of the bail-in process. And it was done as much or more by the political authorities as by the regulatory authorities.
Viral, do you want to comment on that one? And then I'll move on to Silicon Valley Bank.
Yeah, I think I would have been quite happy with the bail-in losses if shareholders had also been completely wiped out. To me, that would have been a much, much better outcome. Just go down, because I think there is but I think what bothers me a little bit is that, the lender of last resort had stepped in so quickly without actually invoking the resolution planning. And, I just feel it shows that, I think it goes a little bit to Charles's point, but I think Credit Suisse may be just a spectacular regulatory failure in my view, because its stock price was deteriorating from February 2021, pretty much every month, 75% collapse over a 2-year period. How could this not have raised red flags? And I think it just shows that our measurement of risk in the capital requirements is very often completely out of sync with what the reality of the risk of a balance sheet is. And so, yeah, I think at a minimum, we should have allowed the resolution planning a chance so that we would have learned what worked, what didn't work. But I feel we are a little bit back to sort of ground zero again, which is, okay, how do we not have these things happen before we enter the state of panic?
I think the three of us probably have twisted incentives here, because as research people, we would like to see resolution in action, because we would learn so much from this new data point. Of course, if you're the authorities that has to pull the proverbial trigger, you may view things a bit differently, I guess.
Right.
Silicon Valley Bank, Charles, it's not really our topic here because we're not focused on supervision. And I think, in a way, your entire presentation was predicated on the notion that supervision doesn't always get things right. But I cannot resist, also because I've devoted several sessions of this series to the question, I cannot resist asking you how you viewed the supervisory failure on Silicon Valley Bank, and how is it possible? I mean, Viral may be constrained because he's working for the Fed right now, but how is it possible that the Fed got it so wrong?
I don't know. And they clearly did get it so wrong. They knew that the situation was difficult. One of the concerns that I have with Silicon Valley Bank is that if I was the CEO of Silicon Valley Bank and I was faced with unlimited liability, I would say to sort of my appeals court that I would like set up, but I was only just following what the Fed told me was going to happen. I was going to know, they said it was that the inflation was going to be very temporary, that we would go back for lower for longer soon. And if they had been correct, Silicon Valley Bank would have made a lot of money. So why are you causing me to have such a huge loss? I was only following sort of the suggestions of the macroeconomic policy that the Fed was claiming. Yes, it was a supervisory failure, but was it in part, I just wonder whether the supervisory failure was there because the supervisors themselves thought for too long that there was no danger in having an enormous amount of duration and interest rate risk. And I would turn the whole thing slightly around and say, you know, where does the Fed stand in all of this?
Viral, where does the Fed stand?
Yeah, let me just mention something from my experience as a central banker at the Reserve Bank of India. Maybe that's easier to say what works, and maybe that helps understand what doesn't work. So Indian banks were constantly going up this up and down cycle of interest rate risks. They would load up on government bonds. They would keep securities available for sale. When interest rates were being cut, they would have nice capital gains. And when interest rates were raised, they would come to the central bank and ask for forbearance, saying, can we move all these securities from available for sale into hold to maturity? Our concern was that this was leading to very poor pricing of interest rate risk in the government bond markets and actually allowing the fiscal deficits to actually balloon without adequate discipline from the bond markets. So we did something very simple. We put restriction on hold to maturity. We basically said no one can hold more than 25% of the securities book into hold to maturity. There were historical reasons why we didn't go to full mark-to-market right away, but even that could be considered. Of course, there was a lot of hue and cry when this happened. It was hypothesized that the bond market will crash when this measure is adopted. And so on. Nothing like that happened. The measures were put in place. Banks shortened the duration of their assets on average from longer than 5 years to less than 3 years. Now we've gone through 2 interest rate cycles of ups and downs, but treasury market gains and losses have not been a source of issue in the banking system. And so my sense is, I think Charles mentioned this point about accounting. I think sometimes we don't pay as much attention to it, but I think it's very crucial because I think like a board member of the Reserve Bank of India really convinced me why restricting HTM was the right thing to do. And he was a former banker, and he said, if a risk doesn't flow into the quarterly P&L of a bank, bankers don't pay attention to that risk. And I thought,
well, I guess a counter argument to that, and not, you know, playing the devil's advocate for a moment, the counter argument to that, and I remember many discussions with Charles about that issue, is that you might get the system to be a bit too pro-cyclical if you get closer to a full marking to market of banks' balance sheet for regulatory purposes. I'm not talking about the disclosure, but I'm talking about the capital calculations here. So, if capital calculations and requirements are essentially responding in real time to market movements, you can have a lot of pro-cyclicality in the regulatory system. So what's your answer to that?
Actually, Charles's 5-author report after the global financial crisis has a nice idea of mark to maturity, which is that you could reward for insured deposits in the capital structure. I would not go beyond insured deposits, at least from my side, because they are the only ones that I think don't have a flight risk associated with them, or at least it's much less than anything else. So you could adjust the extent of HTM that you allow based on
Held to maturity.
Based on the extent of insured deposits. I think it seems like a very sensible thing to do. So you basically say, listen, there's a trade-off, but how much I'm willing to weigh in on the side of procyclicality versus good reporting is going to be a function of how stable your liability base is.
And indeed, that would have been a test that Silicon Valley Bank would have found. They would have had to adjust their business model a bit. So we have a question from Marcel Magnus, Charles. To put your idea into practice, would the first step possibly be to forbid senior bank managers to hold D&O? What does that mean? D&O is director and...
it's directors and officers.
Liability. And officers, right, exactly, thanks. Liability insurance contracts. Have you thought into this?
Yeah, I don't think that's a problem. The reason is that if you were actually providing that insurance, and the CEO has unlimited liability, what premium would you charge? The answer is that you would charge one hell of a huge premium, so that the ability of the CEO to protect himself or herself through taking out that kind of insurance would run into the most enormous costs.
Right. So that
I would just add to that the insurance company would be watching that bank like a hawk, because it effectively would mean that the insurance company would have unlimited liability. And that means that the insurance company would have to take measures to protect itself. And that indeed, in turn, would, I think, constrain the ability of the bank. So I think the idea that the DIA, whatever it's called, the insurance, it wouldn't be a problem.
Viral, do you agree with that? You mentioned private market mechanisms to try to offset the liability.
Yeah, I think this is the issue where I don't have tremendous clarity on, but I think if we have to go down the path of requiring some kind of unlimited liability or state contingent penalties on insiders, I think it requires actually transparency and some restrictions on their ability to unwind the liability. So I don't see how they can push it off to an insurance entity, and then the insurance entity now is effectively the entity that will have to monitor the risks. I think that would, to me, that would be a, let's call it a regulatory arbitrage, I think.
Right.
Yeah.
But if you were providing insurance, would you provide insurance to a CEO with unlimited liability? And I certainly wouldn't.
Yeah, I think that's a very interesting question, I think. Yeah, absolutely. Yeah.
So there's a question from Giancarlo Rizzi asking if the paper is available right now. And yes, it is, again, by Charles Goodhart and Rosa Lastra, Journal of Financial Regulation 2020, but actually there are also versions of basically the same paper which are in free access if you're not a subscriber through an academic institution. So the title is Equity Finance Matching Liability to Power. Geoffrey Underhill is asking whether basically the point about the linkage with monetary policy. So maybe coming back to the point that was made about Silicon Valley Bank and the CEO saying in a hearing in Congress, the Fed told me inflation would be transitory, so I took that on trust. Charles, how do you think about that? Is there something to be said from the experience of this year's crisis in terms of the linkage, which you have thought about a lot, between monetary policy and banking supervision?
Yeah, well, there's one thing that I've done. I've recently did a very short paper on VoxEU, arguing that central banks should be less keen to have their projections of the future based on what are effectively single point estimates of inflation, interest rates, output, and so on, and instead that they should do risk scenarios, but never 3 risk scenarios, because then people look at the middle one and ignore the other 2, and you're back at single point estimates. I would much prefer to see a central bank sort of doing a risk, sort of a high risk or a lower risk alternative, and not giving exact estimates of what the probabilities of either of these risks are. First of all, they don't know what the probabilities are. But
so obviously the Bank of England does fan charts, and other central banks have done that as well. So you would encourage them to do more of that?
I've said elsewhere, the fan chart was a gallant failure. Virtually nobody looks at it. And when Mark Carney was governor, he actually squashed the fan chart in the sense that both the scale of the length, width of the fan was held constant throughout his period in office, and the skew was held at 0. So the fan chart became useless. And nobody really looks at it. And Hugh Pill, the chief economist of the bank, has done really quite a lot to try and reinstate the fan chart. And particularly, he has introduced a situation where the modal point forecast for inflation is quite low, back to target. But there's a very considerable upward skew, a high risk. But virtually nobody in commentating on this or looking at it has taken any notice of that. So the politicians are very busy and have a very short sort of scale of time of they can concentrate on. So what they want are single point estimates. And I think that is what central banks should not give them. But again, Viral has had a sort of more recent experience at the Reserve Bank of India. Do you think that central banks should get away from single point forecasts, as I do?
Yeah, I fully agree with you, Charles. We used to have these fan charts, and we just used to joke that, let's just like put something around, let's just put some band around. And we even used to wonder whether we can just draw this, or do they have to come out of models or whatever, I think no one pays attention to them. They are not terribly informative. And they're not terribly informative because they are not part of actually any conversation or observation or a remark that the central bankers have. Personally, I'm very hesitant with point estimates. I believe there's tremendous model risk in the transmission of monetary policy and the lags and so on. And I think what is more helpful and useful is actually to talk about what the central bank believes is the transmission mechanism. Is it working right now? Are there reasons to believe it may be fast or slow than what it has been historically? Are there financial froth aspects to worry about in the transmission? Or is it just sort of like the benign real sector transmission that one has to go about? And sometimes I feel the qualitative aspects of these conversations as to where you think the monetary policy is traveling, in which crack of the financial system it's traveling in the right way, in which cracks it's not perhaps traveling in the right way. I think that conversation is far more helpful. We had a system at Reserve Bank of India that I quite like, which is that every member of the Monetary Policy Committee writes their own minutes. Right. What conversation they had in the Monetary Policy Committee meeting, what was the backing behind that conversation, why did they vote in line or not in line with the rest of the things. And I thought it was great because it allowed me to have a direct conversation with the world about what I thought was going on in the Monetary Policy Committee decision. So there is a resolution of the Monetary Policy Committee as a whole, which everyone signs off on. But 2 weeks later, every member puts out their own minutes. And I think it leads to a very rich discussion of the way the conversation went.
Very interesting. We have a question from Alan Berner. Back to you, Charles. He's asking to what extent bank management actually understands the risk they're actually running. So in a way, it's a kind of behavioral question, right? If they're suffering from irrational optimism, which distort perceptions of risk, do you think the unlimited liability will really change their behavior. I think I have a guess about your answer, but how do you respond to that?
I don't think, in fact, I'm sure that unlimited liability will not end bank failures. There were loads of bank failures in the UK in the period when all bank managers, I think it's bar the Bank of England, had unlimited liability. I think that in part, the proposal that I'm putting forward is to try and restore a sense of fairness. What people, I think, felt very strongly, particularly after Lehman, was, and Fred Goodwin and so on, was that the bank managers walked away still extraordinarily rich people, while a lot of those who suffered severely by having their houses repossessed and so on, got stuffed. There was a feeling that the little guy got stuffed. The guy who took the decisions that led to it all had a perfectly good time. And it's as much an attempt to change, if you like, the moral structure of the system as a belief that this will necessarily reduce bank failures. And I think that there is a tendency for there to be a number of crucial decisions which affect the way a bank's profits work. And if somebody comes in and gets, say, 2 or 3 of those decisions correct, people will tend to think, and that person may themselves think, that they are wonderful. And when maybe they've just been lucky in the 2 or 3 critical decisions. So I think that it often is the case that the person who gets appointed has an overestimate of their own abilities and an underestimate of the risks that occur. But I don't think that that will change if you go to unlimited liability. I don't think that this is a way of, it will have some effect in reducing risk-taking. I don't think it will eliminate excessive risk-taking. It won't eliminate failures.
So we have 2 questions about the practical implementation of that. Alexander Privitera is asking how the system would affect the current resolution regimes and requirements. And I guess the answer, it wouldn't. It would be complementary to the resolution architectures that had been put in place, correct?
Yeah.
And Lea Cecchino is asking how it would be implemented in practice. And I guess the answer is legislation, right?
Have to be. Because if you change from limited liability for everyone to unlimited liability for one person and multiple liability for others, I think it must be a legislative change because it's a change in the basic structure of the rewards and penalties, and that is a matter for government.
So Pierre Raffi is asking, we're getting close to the end of the session, but just before we conclude, Pierre Raffi is asking what happens with, different shareholder structures. If you have a lot of shareholders which collectively reach your threshold, how is that addressed? Viral already sent some elements of an answer through the Q&A, but also if you think of cooperative banks, how does they're big in many European countries. So does your proposal apply to cooperative banks?
I'm not an expert on the continental cooperative banks, but with cooperative banks, there still has got to be a small group of executives who take the decisions. And that should affect them as much as the group of executives who take the decisions with ordinary commercial banks.
Yeah, if I could just step in there, means I'm also less familiar with the continental cooperative banks, but it's good to keep in mind that there are 2 reasons why banks fail in practice. It's risk-taking or fraud, or combination of both. My read, for at least from data of some countries, is that frauds are far more common in cooperative banks, and risk-taking is like a bigger concern in the larger banks. So I personally think unlimited liability should apply to both. And I want to stress one point that Charles mentioned, which I think we didn't discuss in the follow-up, which is that I think it could be like an interesting matrix approach, which is that either you tell the shareholders you have to hold very high levels of capital, or they have to put unlimited liability on the management. So you could imagine a legislation which also works on this matrix kind of approach, saying, listen, either you have to be extremely well capitalized, and then you get some concession in the unlimited liability on the management. Or if you want to remain as shareholders to be not as well capitalized as on the right end of that spectrum, then you have to increase the unlimited liability on the management. And I think that might be, there could be something, there's something appealing about that, which is that we are trying to ensure there is sort of enough capital, like loss absorption and incentives, and you can allow the two to be traded off in the capital structure by the management and the boards.
Thanks so much. Unfortunately, that will be the final word of the session because we have only an hour, but there's so much more to be said. And I think this is a very thought-provoking proposal, and more generally concern about how to think about the incentives of executives in the financial industry. So thanks so much again to both Charles and Viral for participating in this. Really extremely, I'm extremely grateful. There will be no other session in September because just because I will be traveling and won't be able to attend, but we'll be back in October. Of course, we'll send invitations in due time. In the meantime, again, very, very warm thanks to Charles Goodhart and Viral Acharya for the insights today.
Thank you.
Thank you.